Welcome back to Inside Options. We're busy talking about the central order book. James, you were saying just before the ad break how brokers would phone in, there were dial-up modems. Things have changed though since
Exactly. I mean, one of the most fascinating things to see has been the gradual evolution of traders as sort of people. What sort of type of people become traders? As I mentioned, they used to be very tall, loud voices, domineering sort of presences, bullying people into giving them the best prices. Now, as the markets become more and more electronic, your broker on average has become more technologically savvy, younger, and not necessarily as big and sort of loud voice, because they don't need to be, because the electronic access is the great leveler that everyone then is able to see what the best price is, and there's complete anonymity. Now, in the past, the best bid and offer used to be written on a chalkboard on a balcony above the trading floor, and you can see some quite fun pictures of that. So in 1995, we moved to electronic trading on the Johannesburg Stock Exchange, and it made a huge difference in the liquidity and the ease of trading on the market. So this is the Aussie, which is our most liquid contract. Sadly, it's quite small, and when I've tried to make it bigger, it just distorts it massively. But you can see here we've got 189,000 contracts of open interest. Each one of those contracts is about 280,000 Rand of exposure. So it's 189,000 times 280,000 Rand. It's a massive market that trades every day. It's very popular with day trading. This is because it's very liquid. So that's one of the things, is that liquidity begets liquidity. It's very tricky to get something that's illiquid to start sort of trading. What you need market makers. So this is a bid offer book. Let's just explain. This is a central order book per se. That's how it works. This is a stack. So we've got September 11, Anglo-American dividend neutral depth window. So our on-screen market is dividend neutral futures, which is a more simple type of future, which is just your spot price plus interest. It's very nice, simple product that we've come up with, and it's really proving to be very popular. You can see the bid and the offer. Now, the bid is always going to be lower, and the offer is always going to be slightly higher. The offer is the price someone is willing to sell at, and the bid is the price someone's willing to buy at. So this book is organized along price, time, priority. So price comes first. If you put in the best price, you go to the top of the bid offer stack. Then for a trade to happen, someone has to agree to trade at a level that has been posted as a bid or an offer. So hitting the bid would tend to drive the market down, because they'll sort of hit whoever's wanting to buy, whatever, just buy it from me, I want to sell. You'll push it right down to, if we went right through the book, to 311. Here, if we were sort of hitting the offer, we'd say I'm desperate to buy, and we push it from 325 to 334. So that difference up there is called a bid-offer spread. So that's a measure of liquidity, is how tight is your bid-offer spread. The smaller the bid-offer spread and the deeper the book, that's a deep market, is one where there are lots and lots of people making bids and offers to sell or buy. And the other one is how tight is that double at the top there.
Okay.
And that's the other measure of liquidity. What that means is that you have to have a move of 324.64. It has to go past 324.5 Rand and 84 cents to be able to profit from that, so you can sell it back to someone. So you need quite a significant move in the price to be able to cross that spread. If the double becomes very tight, you can get in and out very easily all day long, and it becomes far less frictional costs of trading. So that bid-offer spread, how does that occur? That occurs mainly because market makers will have a price that they're willing to sell at and a price they're willing to buy at. And those two prices, that difference between them is a bid-offer spread, and that's sort of their profit margin. They'll buy low and sell high. That's basically it. Or sell high and then buy it back low. That's how that market works. That's what a market middleman does. He buys low, he sells high. So market middlemen make a nice profit from the bid-offer spread. That's what keeps them sort of involved in trading. Now, the fascinating thing is that more market makers means tighter doubles. You can see here, if we had one guy in red, he's made a 1.5 Rand double. Another guy in green, he's made another 1.5 Rand in double. Generally, these are going to be banks. Let's say that's the green bank, that's Nedbank, the red bank, that's Absa. So they're both putting up prices in our central order book, and 1.5 Rand wide, 1.5 Rand wide. But together, when you put them together in the central order book, that double narrows then to 1 Rand. And the more guys you get in there, even though they may keep their spreads equally wide, gradually the price gets tighter and tighter until it becomes a very efficient, effective market that you can then trade in profitably with low frictional costs. That's actually what you want when you're trading. You want low frictional costs to be able to get in and out quite easily. So these are the main benefits of a central order book. you can have as many participants as you want. You can have far, far more people trading in a central order book than you could ever fit into a specific designated small space. It's transparent. Everyone can see what the prices are. Everyone can see what the bids and offers are. It's a level playing field because no one knows who you are. There's no sort of, I know that guy, don't know that guy. There's no possibility of preferential procurement because it's totally anonymous in the central order book. It's an electronic order. No one knows where it's coming from. It's accessible. Anyone can get in. Very easily to connect into. It's the most efficient way of doing it. You can actually trade more per day by doing it this way, rather than having to sort of negotiate each one. We've also introduced a billing model, which is called the maker-taker billing model. We've actually made it cheaper to trade on screen than to report a trade onto the system. This is just a further incentive to make people trade on screen. So you get lower trading fees because of that. Gives you price discovery in a transparent way. That means that the price you see on the screen is an consensus view of all the market participants wanting to buy or sell a security at a given time. So you know that there is one price. Problem is, if you've got sort of an over-the-counter product, like maybe a CFD, you don't know what that one price is. I mean, just in my sort of ad hoc researches of looking at those, you can see that each guy is charging a slightly different interest rate. So let's say you were Piet Pompies from Pofadder, you're going to get a very different interest rate because your credit profile looks very different and your attractiveness as a customer looks very different to one of South Africa's biggest hedge funds. They're going to get a far better rate than you would. Whereas in here, it's a central order book. Everyone has the same credit and the same standing, which we guarantee through the clearinghouse. So there's no credit risk and everyone's on a level playing field. So you can actually get these amazing wholesale interest rates.
Have you had any resistance from brokerages in the country
we have.
adopting the system, and why?
It's a big change. And a lot of people have sort of resisted the change just because they're sort of stuck in their ways and they have to change their business model quite a bit.
How much is it going to cost them? I have to ask.
Exactly. That's the thing, is systems development is the major cost. But luckily, a lot of our guys have developed very, very good systems that are already available to the general public. And continually more people are doing that. The only way to really grow the market is by adopting electronic trading. We've looked at every market around the world that has introduced this, has seen a massive, massive growth in volumes.
Are you going to enforce this at any point?
Yes, we do actually have minimum trading rules now already in place on the top 40 instruments. Those sort of came in at the beginning of 2011, end of 2010, that anything in the top 40 beneath certain size limits, which you can find on our website, has to trade on the central order book. So the smaller trades all have to trade on the central order book. And that's mainly just as a protection measure so that you know you're getting the best price possible. Also to get that trade going onto the central order book, getting more people in there. It's the way to grow the market. And it's a free market. So you can trade with anyone. Whereas if it was another product that you can't trade on a central order book, then you can't trade with anyone else. You're stuck with one person. That's the main reason for it. A free market, efficient market.
That's your central order book. Thanks very much for joining us. I think we'd like to pick up on the topic of brokerages in South Africa adopting the system at some other point in time. Perhaps invite a few of them in.
We will do.
Discuss it. Thanks very much.
It's a pleasure.
That was Inside Options. See you again next week.
Inside Options was brought to you by the Johannesburg Stock Exchange. Manage your risks with SAFEX style options.